So good morning.
Morning, James.
Thank you very much for coming back and doing this again.
That's okay.
Um, as always, though, we're going to assume people don't necessarily know about Henderson High Income. So I'm going to let you talk about the fund a bit first, and then we'll get to some questions, please.
Sure, sure. So if you move to the next slide, and then I think this really kind of sums up the trust. If the name doesn't really give it away as such, it's a trust there to deliver a high level of dividend income to shareholders, but also the prospects of capital growth. And what I say is, we do deliver the income, but we do it in a diversified way. So if you look at the chart on the left-hand side here, you know, yielding 6.6%, that's clearly, a significant premium to the likes of yields you can get into other asset classes, whether that's the UK equity market, whether that's in bond yields, or whether that's in interest rates there as well. Clearly delivering a higher premium income to all those other asset classes. But like I said, we do it in a very diversified way. So if you look at the right-hand chart, the orange bars represents the amount of income that the top 20 companies in the FTSE 100 contribute to the overall market income. And as you can see, it's 75%. So the UK market gets a lot of criticism about being overly concentrated for income. And that's very true. What I would say is, even though we're a UK equity trust, or predominantly UK equity trust, we are still a lot more diversified in terms of where we get that income from. And actually, those top 20 companies, they only contribute to around 30% of our overall income. So, high income, diversified way. If you move to the next slide, just a bit of background. And I guess the key element of why we are diversified, and it's what goes back to our very much our unique feature, is yes, we're predominantly a UK equity income trust, but the thing that really differentiates us is our ability to own bonds. And that should be seen in the context of the gearing within the trust. And I'll obviously come on to talk about that in a bit more detail as well. I mean, typically our benchmark is 80% equities, 20% bonds. So you can kind of get the idea of how the asset allocation works between the two asset classes there. We are very much bottom-up stock pickers with a keen valuation discipline. Again, I'll go through that in a bit more detail. And we're very, despite being income, it's not just about dividend yield we focus on. We also concentrate on dividend growth. And again, I'll kind of talk about why that's important going forward. It is a well-established trust. We were launched back in 1989, and we've grown to about 375 million of gross assets as well. Next slide, please, James. I talked about the high income. The other thing to mention is probably we don't just offer a high income, we also offer a growing dividend as well. So since I've been involved in the trust back in 2012, we've grown the dividend every year for the last 12 years at a compound average growth rate, a yearly growth rate of around about 2.1% there as well. So, admittedly, it's only modest growth, but given the high starting yield, actually, I think that becomes quite a powerful compounding story going forward, given that 6% plus starting yield and a 2% dividend growth track record going forward. In terms of revenue reserves, so, one of the most important features of an investment trust, certainly for income, we're around about 50% cover in revenue reserves compared to the cost of the dividend today. So again, that should helpfully give comfort to shareholders that the high dividend and the dividend growth that we've delivered in the past can continue going forward, even if we were to go into more difficult times for income generation for UK assets there. Next slide, James. So going to talk about a little bit more detail about the bond element and where we utilize gearing. So another key feature of investment trust, our ability to use borrowings. And that is a really a strong feature of this trust. So where we have long-term fixed rate borrowings, costing us 3.67% in terms of that coupon cost, we invest that money in a broadly stable portfolio, bond assets yielding 5%. So clearly a higher yielding bond portfolio than our cost of borrowings, and therefore that helps generate that extra income for the trust. That's very much a structural element, so that's a permanent element of gearing to help generate that high level of dividend income. Once you strip out that permanent or that gearing that backs the bond portfolio, acts as gearing towards equity, which is kind of the more traditional way of thinking about equity investment trusts. That gearing towards equity is around about 9% at the moment. So much more in line with the AIC UK equity income sector there as well. Now, what is the role of the bond portfolio? As I mentioned, one of the key elements is very much boosting the headline yield, but there are other benefits of it as well. Firstly, through diversification, and secondly, through resilience of income. So, if you go into more difficult times, you could clear example is when we went through the COVID period, where 40% of the UK market cut their dividends. Actually, having a bond portfolio where typically you see bond coupons are rate higher than dividends. Companies are quick to cut dividends. Bond income is a lot harder for them to cut, and it signals a lot more difficult times. So it's much more resilient in downturns. So it helps provide that certainty of income, even if you go into a bit more of a difficult period for markets and economies there. And the last point, it kind of dampens down the overall volatility. In more stable markets, effectively what you do see in more benign markets, you see bonds are actually typically, especially in downturns, much more stable than, say, equities. So again, having the gearing there backed by a bond portfolio actually helps dampen down the overall volatility. And you can kind of see it on the chart on the right-hand side there, which is just tracking the volatility of the NAV versus the FTSE All-Share. And as you can see, actually, we're pretty close. So even though on a headline level, you look at the gearing at 23%, actually having the balance between utilizing borrowings and investing in bond assets means the actual overall volatility of the NAV hasn't been too dissimilar from the FTSE All-Share there. Next slide, please, James. In terms of stock selection, so what do we look for in companies? I kind of break it down into three key areas, really. So firstly, fundamentals, really understanding the key attributes of a business, what it does, what markets it's in, how it derives its profits, etc. And I think the three key points for me that I focus on is business models, really understanding, do we understand this business model? How robust is it, etc. And effectively, we're looking for businesses that are going to be around in 10 years' time or even more. Then we've got to look at its barriers to entry, high barriers to entry, defendable barriers to entry. So effectively, that business model can be protected from traditional competition or more lately, more sort of new digital companies' entrance into the markets that disrupt an industry. Are the businesses we're typically going to invest in, the more mature businesses, are they safe from that new competition as well? Again, it's kind of getting a feel for how sustainable is a business model in the very long term as well. And then a third key point about the fundamental analysis is just understanding who are running the businesses, who are deriving the strategies that are going to deliver the growth that you want as a shareholder. And it's about having that proven management team. I think the last couple of years has kind of shown that, firstly with COVID, how they're going to manage their business through what was a very existential risk to their businesses, but also in the very high inflation environment that they suffered as well. How can you manage your cost base to be able to keep driving profits through quite a difficult period as well? Then I move on to the financials of a business, really understanding how sustainable are the returns, how sustainable are the profits, the margins, etc. And ultimately, how well invested a business is as well. So, it's all very well us as income fund managers wanting everything paid out as income. Actually, we don't. We want them to properly invest in their business, not only sustain their business today, but be able to grow those profits in the longer term. Because, a growing profit stream will lead to growing cash flows, will lead to a growing dividend as well. And that's the key for us. Again, it goes back to not just a dividend yield, but it's about dividend growth as well. And then the last point in the financials is very much focusing strength of balance sheets. I think that's key for us. No one has got a crystal ball. We can't call markets or economies exactly right or when the turning point will come. But as long as those businesses we invest in have strong balance sheets, actually when times get tougher, when the downturn comes, actually the strength of those balance sheets mean that you're more likely to receive those dividends than not. So that's a sort of key feature for us. And then the third part of the process is very much valuation. And this really underpins the whole process. So it's all very well finding a good business with strong fundamentals and good financials as well. But if it's already in the share price, if it's already reflected in the valuation, then your capital appreciation over the longer term is quite limited. So it's about finding those right businesses, good fundamentals, with what you think are good financials that can improve, but being disciplined on the price and the valuation you pay for it. And I think combining that all together, has delivered, good total returns for the underlying shareholders historically. Move to the next slide, James. So this slide goes into a bit more detail about the importance of not just focusing on dividend yield and focusing on dividend yield and growth at the same time. So the chart on the left-hand side there just shows you actually dividend yield in isolation can be a misleading guide to value. And what it shows you is the black bars show you what dividend yield you thought you were going to get at different levels of dividend yield. And the orange bars show you what you actually earn. So as you can see, the higher the dividend yield, so the further up the right-hand side of this chart you go, actually you don't receive that yield. And that's why, for me, we always kind of hunt for equities for companies that pay typically a dividend between the 2 and the 4% dividend yield range, or the 4 and the 6% dividend yields, because historically those dividends have proved to be much more sustainable in the longer term. When you go up to the right-hand side of the chart, what you find is you're in that sort of value trap area of the market where those high dividend yields you thought you were going to get, actually they get cut. And that is quite painful, because it not only hits your revenue account, but actually it hurts your capital as well, because generally share prices do go down on a dividend cut. If you look to the chart on the right-hand side, this shows you what your total return historically was or has been in the UK market, broken down by yield buckets. So as you can see, again, it's that 2 to 4% yield range and that 4 to 6% yield range that has produced the best total returns historically in the UK market. Again, because it's that combination of both dividend yield and dividend growth, those are the main contributions to total return. So focusing on that sustainable dividend and companies that can grow that dividend quite healthily, then actually that's produced the best total returns in the UK. So that's why we hunt. I always call it the sweet spot of income investing, is to look for companies within that 2 to 6% yield range as well. And I think that comes back to the whole structure of the trust. So being able to utilize borrowings to invest in a bond portfolio to boost your headline yield, it means within the equity portfolio, I don't have to be too far up the right-hand side of these charts where dividends are unsustainable or where you get lackluster total returns as well. We move on to the next slide. So that was very much a very sort of quick whistle-stop tour of introduction into the trust. In terms of, I guess, market outlook, one of the things that I've been probably saying forever and a day is just how cheap the UK market is. And people have been, quite rightly saying, oh, what's the catalyst? What changes that, etc. The UK has been a dire market for years, etc. What I try and show in this chart is that the UK market hasn't always underperformed. I've looked back at the total returns of the UK market relative to global index, going back in previous decades. And what you find is back in the 70s, 80s, 90s, and early 2000s, is actually the UK market outperformed global indices. So actually the exception has been in that post-GFC, post-global financial crisis period, when interest rates have been zero, the UK market has lagged, and it significantly lagged the global index. So when you look back and analyze, well, what was different back in, again, those 4 other decades, was actually interest rates. So actually interest rates were a lot higher, much more normalized, etc. And that was a period where UK actually outperformed. And it's the exception to the rule. It's really been when we've been living in this zero interest rate environment that's boosted global indices. And let's be honest, it hasn't always been global indices. It's generally been big US tech companies, etc. And that kind of makes sense when your cost of, when your cost of capital is zero, effectively you can go out, valuations don't matter. You can buy most things and actually you'll make a return out of it. It hasn't really mattered. You buy, the popularity in, say, the period in 2021, etc., towards this, zero profitable tech, etc. The price you paid for an asset didn't matter. Now that interest rates are much higher, or historically when we've seen interest rates higher, actually valuations have mattered. The price you pay for an asset when your hurdle rate now on your cost of borrowing is so much higher, actually the valuation, the starting price you pay today makes is being much more important. And I think you've kind of seen it so far this cycle. So the chart on the right-hand side there just shows you the performance of the FTSE 100 relative to global index. And what we've seen is since the end of 21, when interest rates started going up, actually the UK market has done okay. Hasn't quite beaten the global index, and certainly in the last month, you know, the US market has gone up again. But actually, the UK market's been okay. And I think again, it comes back to the whole point of valuations now matter because interest rates are higher. And if you think interest rates are going to stay higher for longer or more normalized, as I call them, you know, I remember buying in my flat, you know, 15 years ago in London, it was, you know, interest rates were 5% then. Actually, if you think you're going to stay towards that sort of level, actually value as a style probably has a better time of it. And certainly the UK market is definitely a more value market. So I think what's likely to be the catalyst to mean that UK could do well, I think we've kind of had it in terms of higher interest rates as well. If you move to the next slide, James. Won't dwell on this chart, but again, you know, just focusing again, what the chart I've probably shown many a times is just how cheap the UK market is. So, you know, currently on 11 times earnings, as Andrew said earlier, you compare that to, you know, how more highly valued the US market is. You know, it's a very cheap, and yes, US market has a lot of tech, but even if you adjust for that on a sector neutral basis, the UK market is still at a significant discount to the US and other overseas markets, but whether it's Europe, whether it's Japan, etc. You know, we are the, as someone says, a sick man of Europe in terms of that market valuation. But I think that's the opportunity. And certainly if we're not going to recognize the value as investors, certainly there is another area of the market that is. So James, if you go to the next slide. You know, I could talk about M&A activity, you know, again, lots of, you know, bids in the market today. You've had Aviva, you know, come forward and buy Direct Line, but we've had other takeovers, you know, Britvic, etc. earlier in the year and things like that. One of the other areas of the market we're seeing recognition of that value is just through management teams and the sheer amount of share buybacks you're seeing. So the chart on the left-hand side there just shows you how much of the UK market we've been buying back. And over the last 12 months, the FTSE 100 has bought back 2.4% of its own market cap. Now that compares to the S&P 500 at 1.7% of its market cap over the last 12 months. Now, the US market, S&P 500, traditionally a much more share buyback focused index, very much because of the tax rules over there. UK market, very much dividend focused. We are still dividend focused, but on top of that, we're still buying back more some percentage of market cap than the US market. And actually across, you know, again, sort of the French and the German markets there as well. And what you say is in terms of that total yield, you know, 3.6% dividend yield, 2.4% buyback yield on top of that, your starting yield as a market is 6%. That's a pretty good starting point. And that kind of, you know, I think, you know, just to get that return is still good. I mean, that's kind of, you know, look at the historic studies over UK equity markets. If you can get 6% over the longer term per annum, that's a good start. That's a good place to be. 6% just from yield, whether it be income and buyback, again, not including any sort of re-rating potential, any sort of dividend growth. Actually, that's a good starting point. And if you look at the chart on the right-hand side, you can see what the power of buybacks are. So I've got a chart here showing the total return of Imperial Brands at the point where interest rates started going up and they started their buyback relative to one of the Magnificent Seven, so Microsoft. Now you could say I've been selective in terms of time period. Yes, I admit, you know, Microsoft over the very long term has materially outperformed. But I would say is this chart surprises a lot of people. You know, a pretty dull, boring tobacco stock has materially outperformed Microsoft, which has been in this AI boom, has got exposure to this AI boom. In fact, Imperial Brands has outperformed 6 out of the 7 Magnificent Seven over that time period. The only one it hasn't is obviously Nvidia, which is up 300%. So I think, you know, you got to put it in perspective and be open about it. What has driven Imperial Brands is the share buyback, effectively. Not only the share buyback, they've actually delivered on the profit guidance they've given in fact, slightly beating it, modest upgrades you've seen. But they've been buying back shares, paying a healthy dividend, and that just has compounded up over the longer term, where you've seen this huge good total return for shareholders, up almost 100%, and the rating has only gone from 6 times to 8 times. So it's still pretty cheap. So that kind of gives you the hint of, those share buybacks, why management teams are deploying them at such a heavy rate, and what it could mean to some of the upside in some of the more sort of traditionally duller stocks that have been particularly unloved in the UK market. If you move on to the next slide. Yeah, it would probably be dismissed of me not to sort of comment a little bit about the budget. It was pretty, from my mind, it was pretty disappointing. I kind of described it as the new government clutching defeat from the jaws of victory. They kind of inherited an economy that was improving. And although they talked about being pro-growth ahead of the election, the budget was anything but. They wanted to avoid tax on the consumer, so they taxed the private sector. Unfortunately, that's probably going to mean corporates are going to look to offset that NI contribution in price rises. They're going to try and offset minimum wage increases through price increases, etc. So effectively, the consumer is going to have to wear it through higher inflation across the high street there. However, what I would say about that is the chart on the left-hand side there just shows you household net borrowings to net savings at the aggregate level in the UK. And what you've seen is since the GFC period, since global financial crisis, we've been in a very much a deleveraging process across the consumer environment. You saw a massive uptick in that through COVID period where we saw huge savings. And I think as interest rates have been rising, people have been paying down their mortgages, have been paying off their debt pile to be managing their monthly costs, where you've got to a situation where actually at the aggregate level, consumers' balance sheets are in a pretty healthy state. When you look across to the right-hand chart there, one of the things I think people were worried about post-budget was the immediate impact on bond yields and how the 10-year gilt yield rose to the level we saw in the trust era during the mini-budget. What I would say is if you look at 2-year swap rates, which is basically what mortgage rates are priced off, actually there hasn't been much movement there. So actually within the housing market, actually people can still refinance their mortgages at pretty good levels, around about that sort of 5% mark, maybe slightly less. Actually that's a lower rate than where we've seen at the beginning of this year. So actually, even though the budget's come through, pretty disappointing. It hasn't had that knock-on impact to the housing market, or it shouldn't, given where mortgage rates are likely to settle as well. So what I would frame it is, I don't get me wrong, I don't think it's going to be exactly boom time for the UK economy, anything but I wouldn't get particularly bearish. I kind of feel we're going to be in this sort of sub-trend growth probably for another 12 months. And actually that improving economy we saw, or we have been seeing, I think that just gets pushed out another year. Now, it's quite interesting. A lot of the domestic companies in the FTSE 250 have reacted quite negatively. So the likes of Taylor Wimpey, Genuit, to the sort of more plays into the housing market that we own, they've fallen, almost 20% in the last month. That's a big move. And actually, they're probably priced in no recovery, whether that's in 12 months or 2 years. So I think actually that's an area of sort of focus we need to be mindful of. And it's not a case of throwing the baby out with the bathwater. You've got to be disciplined on valuation, because ultimately I think, the UK market is not going to go recession. I think you're just going to see sub-trend growth where the likes of those businesses can still make okay profits and can still pay an attractive dividend, even in that sort of more subdued environment. Move to the next slide. So where are we seeing opportunities? I've given sort of 3 examples here. The first one is sort of value for money. That's an area of where we focus on retail for quite some time. It's worked really well for us. One of the new additions we've had this year was in Dunelm, so the homeware retailer. What we've seen is they've taken significant market share in that area of the market, even in quite a tough environment, because they offer good quality homeware products, but an attractive price that competition just can't compete on. So, and they've got quality tiering. So whether you're buying a £2 picture frame or whether you're buying a £35 silk pillowcase, that's still at a significant discount to where the competition can charge for the same quality of product there. So we think, in an environment where inflation is probably going to tick higher, consumer probably under a bit more pressure again, actually they can continue to make market share as they see consumers trade down to that value offer there. The second one is within the banks. So again, if inflation ticks higher, interest rates probably stay, or they're probably on a falling path, but not as aggressive as we probably assumed pre the budget. In that environment, interest rates staying high, that's a good environment for the banks, certainly the domestic ones. And also it's been very rational market. So, mortgage margins for the banks have been pretty stable. I think that continues. And what we like about the likes of NatWest, I know it's been really strong this year, but actually it's got what's known as a structural hedge. So they hedge out a lot of the interest rate risk within their balance sheet. So even if you see interest rates come down, they can still grow their profitability as they reinvest that structural hedge at a higher prevailing rate of interest rates. So again, we see that profit growth that we've seen over the last 12 months can continue. And at the moment, they only pay out 40% of their earnings as a dividend. Because of the government stake. Now, we think in the first half of the year, they will be completely out of that government stake. They're doing a directed buyback, buying out the government of their stake. Actually, if you look at where the payout ratios for the peer group is, it's much more in line with sort of 50-60% payout ratio. So once the government is out, actually, we think that payout ratio can increase. So the dividend growth that we expect should accelerate as that payout ratio increases more in line with the wider peer group there as well. And then the third one is kind of a turnaround situation. So, the outlook for the UK economy, again, is a bit more clouded. The outlook for the global economy, again, we don't know what Trump's going to do in terms of tariffs, so we need to be mindful of that. So what we're trying to find is very much, those turnaround situations that can generate profit growth, value realization without too much reliance on the global economy. And I think Reckitt Benckiser kind of fits into that. It's one that's been pretty poor share over the last 5 years or so. In terms of the actual underlying organic growth it's been delivered. It's got litigation risk in the US and stuff like that. What I like about it is actually I think that litigation risk has been de-risked, shall we say. They won the most recent case in St. Louis, and certainly I think the worst case scenario is overly discounted in the valuation now. They are selling off some of the lower performing assets. Again, I think there are buyers for those assets. I think they get a good price for that. And actually the rest of the business, what they're going to focus on is in good categories. It's actually growing organic growth well. They've got very good, strong brands and good market leading positions. And actually, if you see disposing of those assets, you see the margin, the cost savings plan coming through, you see higher growth business, it deserves a significant re-rating on the back of that. So, it's one we like, which we think is particularly undervalued right here, right now. Last slide for me, I probably won't go through it in too much detail, just shows you where we're positioned in terms of some of that sector exposure, where our top 10 is. What I would say is it's probably a good mix between some of the sort of stable, higher yielding areas of the market, but also some of the names we have that offer a bit more growth into the portfolio. So the likes of the 3Is of this world, REDX, Unilever to a certain degree, offering a bit more growth versus, some of the sort of high yielding names, whether that be some of the tobacco names, oil, or utility space there. But I'll leave it there, but happy to obviously answer anyone's questions that may have come through.
Brilliant. Thank you very much, David. Few questions about the bond portfolio, if you don't mind. So can you sort of tell us what the yield is on that and how that compares to the yield on the equity portfolio, please? And also, what sort of bonds do you hold and what sort of geographic spread of them?
Yeah, so the bond portfolio probably yields about 5% at the moment. The geographical split would be half UK, half US dollar bonds. Again, I think we have the facility to go up to 30% overseas within the trust, and the bond team like to use that within the bond portfolio because actually there's deeper pools of capital in the bond markets within the US bond market there, so they use that. In terms of kind of the ratings of the bonds, typically where we've been is a third is government bonds, third is investment grade, and a third is sort of high yield. So a real blend of sort of quality. We're probably shorter duration than the benchmark at the moment, which is actually, in a world where we've seen bond yields rise, actually the bond portfolio has been a lot more resilient than the benchmark. So they did a good outperformance against their own specific bond benchmark there. So hopefully that gives you a feel for the overall bond portfolio.
And then I think you mentioned, so you can invest overseas. To
Yeah.
what extent do you use that, and when what do you use it for?
Yeah, sure. So within the equity portfolio, I think we do it effectively. There's a couple of reasons why you would do that. The UK market can be quite concentrated within certain sectors. So the classic example is within pharmaceuticals. So we've only really got two pharmaceutical companies in the UK, AstraZeneca, Glaxo. So actually, I own both of those, but I also own Sanofi as well, the French pharmaceutical company. It gives you a way of increasing your overall exposure within a sector, but not necessarily being too concentrated to two stocks in the UK. The other reason we would go overseas is to try and find exposure to certain themes that are underrepresented in the UK market. So we own Texas Instruments, which is a semiconductor listed in the US. Again, there's no real exposure to semiconductors, which is pretty much a long-term structural growth industry. So we've gone into the US market to get exposure through Texas Instruments. So those are the two main areas you would do it. There's also just single stock examples where you're happy to go overseas to own something. So we've recently bought something like Sodexo, which is a French contract caterer. Again, I think there's a good turnaround story in that business, which again that's the kind of stock specific where I'm happy to go overseas. I sit amongst the global equity income team at Janus Henderson, so we've got a wealth of experience of looking at some of those overseas opportunities there within the house and within the team.
We've talked a bit about sort of bond yields moving around and interest rate expectations moving around. What's your attitude to things like utilities in this environment? I know you've got 6% there. And there was a specific question about would you be tempted by any of those yields on the renewable energy funds and the infrastructure funds in the closed-end space?
Yeah, so if I answer the latter part first. So we can own a few of the alternative investment trusts, and we do. The two we own at the moment is Greencoat UK Wind. So trading at 20% discount, 8% dividend yield. The underlying cash flows are backed by a lot of it. 60% is backed by government subsidies. So it's pretty well covered, that dividend. And it's a big trust. It's liquid. It is probably, I think, the one that's got the longest track record. So and I've met the management team, many a time. So, they're pretty sensible guys as well. So I feel pretty relaxed about that one. Some of the newer ones, I don't know too well. You just wonder whether the yield is kind of the tail wagging the dog, where certainly with Greencoat, the way it was set up, it was the other way around. It was, what the cash flows are and that's supporting that dividend. You don't know whether the dividend was a starting point to get to that. The other one we own, we quite like, actually, not in renewables, but investment trust, is Tufton Oceanic Assets. So shipping assets, they've done really well to grow their NAV. Again, it's investment trust for some reason, trading at quite a big discount, big dividend yield, really well covered by cash flows. Again, really strong management team that's proved over the longer term. So again, that's one we like. In terms of the listed utility space in the UK, I pretty like, we talked about, the long-term energy transition in the UK, the likes of SSE, the likes of National Grid. National Grid are investing a lot in terms of the infrastructure that you need to be able to connect a lot of those wind farms, solar farms, etc., into the grid. So like that, given the returns you're likely to see on that investment is, well, it's regulated. We know what the returns are like. It's about being able to deploy that capital in a cost-effective way. So we like National Grid. We also like SSE. Again, it's got the infrastructure, but it's also got they're actually one of the developers of the wind farms, etc. And I like the business because it is having those two together. It means you can actually allocate capital between them depending on where you're seeing the best returns at the moment. Again, I like that. The shares are pretty inexpensive as well, and they pay a good growing dividend yield.
That's great. Thank you. I think we've probably run out of time, but thanks very much for your time today.
That's okay. Pleasure.
really good. There's some performance numbers there, which we have to put up, and then some disclaimers. Um, just on terms of the dividend outlook, I know that's something that's more in the board's control than yours, but do you is the ambition to grow it ahead of inflation over time, or is that something that it's harder when you're on a very high yield to start off with?
Yes, it would be harder for a trust like us, given the high starting point, to sort of grow in line with inflation. I suppose if you look at the history of what we've done over the last 12 years, around about that 2% level, which I guess is kind of, think about CPI and what the target rate is of the Bank of England, we've kind of done that. So you would hopefully be able to maybe sustain that in the longer term. It's not a stated goal or anything like that. But I think that's a track record that I think has served the trust well. So hopefully it can continue.
Brilliant. Thank you very much indeed for today.
A pleasure.
Good luck with it all, and we'll talk to you again soon.
Thank you very much.
So we're back next week talking to Craig Baker from Alliance Rotan about the merger and what happened to the portfolio since that happened. And then we've got a break for Christmas, and Andrew and I will be back at the beginning of January talking about the whole of 2024 in a sort of great sort of mammoth roundup. So have a good weekend, and we'll see you again next Friday. Thank you.